What if I told you that the world's greatest investor, a man worth over $130 billion, built his entire fortune on just two rules? Rule number one, never lose money. Rule number two, never forget rule number one. That is it. That is Warren Buffett investing philosophy in two sentences. Simple, right? But here's the thing. Most people hear those words, laugh, and say, "That's obvious, Mano," and then they go ahead and lose money anyway. I'm Mano, and in today's video, we're going to break down what Buffett actually means by this rule, because I promise you, it is not what you think. By the end of this video, you will understand the deep philosophy behind this principle and how you can apply it to completely transform the way you invest your money. Let's get into it. Let's start at the beginning. Where did this rule actually come from? Warren Buffett was born in Omaha, Nebraska in 1930. He bought his first stock at age 11, 3 shares of Citi Service Preferred at $38 per share. The stock dropped to $27. Young Warren held on, sweating every single day, until it recovered to $40 and he sold. Then the stock shot up to $200. That early experience, losing money, then recovering, then leaving massive gains on the table, taught Buffett a lesson he carried for the rest of his life. The pain of losing money is far more costly than most people realize, not just financially, but psychologically. From that point forward, Buffett made it his mission to never be in that position again. He studied under Benjamin Graham at Columbia University, the father of value investing, and Graham hammered one concept into Buffett's mind above all others: protect your capital first. Profits will follow. This became the seed of what we now know as rule number one. But here's where most people get confused. They think Buffett means you should literally never have a losing investment, but that's impossible. Even Buffett has lost money on individual investments. So what does he actually mean? Let's get into the real meaning behind rule number one. When Buffett says never lose money, he's not talking about never having a bad day in the market. He's not saying your portfolio will never dip. What he is saying is this: never make a permanent, catastrophic loss of capital. There's a massive difference between a temporary unrealized loss, where a stock drops but eventually recovers, and a permanent capital destruction, where you put money into something and it simply never comes back. Think about the difference between these two scenarios. Scenario A: you invest $10,000 in a quality business. The market crashes and your investment drops to $7,000 temporarily. 3 years later, it's worth $16,000. That's not losing money in Buffett's eyes. Scenario B: you invest $10,000 into a speculative penny stock, a meme stock, or a company with no earnings. The company goes bankrupt. Your $10,000 is gone forever. That is what Buffett means by losing money. Rule number one is fundamentally about asymmetry. Buffett obsesses over the downside before he ever thinks about the upside. His first question when looking at any investment is, how much can I lose, not how much can I make? This is a complete mindset reversal from how most retail investors think. Most people see a stock and think, this could go up 50%. Buffett thinks, what happens if I'm completely wrong? How much of my capital is at risk? And this leads us directly into the concept that makes rule number one work in practice: the margin of safety. The margin of safety is the engine behind rule number one. Buffett borrowed this concept from his mentor, Benjamin Graham, and it's arguably the most powerful idea in all of investing. Here's how it works. Every business has an intrinsic value, what it's truly worth based on its assets, earnings, growth potential, and competitive advantages. This intrinsic value is separate from what the stock market says the business is worth on any given day. Markets are emotional. Investors panic. Markets overshoot, both on the upside and the downside. This creates opportunities. Buffett's strategy is simple. He calculates the intrinsic value of a business, then he only buys it if the market price is significantly below that intrinsic value. For example, if he determines a business is worth $100 per share, he won't buy it at $95 or even $90. He wants to buy it at $60, $50, maybe even $40. That gap between the intrinsic value and the purchase price, that's the margin of safety. Why does this prevent losing money? Because even if Buffett's analysis is slightly wrong, even if he overestimated the company's value, that buffer protects him. He didn't pay full price for something he was already getting at a discount. Think of it like real estate. Imagine a house worth $500,000. If you can buy it at $350,000 because the seller is desperate or the market is fearful, even if you make some mistakes during renovation, even if the neighborhood takes a little time to appreciate, you still come out ahead. You bought with a margin of safety. But here's what I want you to understand. The margin of safety is not just a mathematical calculation. It's a philosophy of humility. It says, I might be wrong. I might have made errors in my analysis. Let me build in a cushion so that even my mistakes don't destroy my capital. That's the essence of rule number 1. Now I want to show you something that will change how you see investing forever. Let's talk about the brutal mathematics of losses. Most people think that if you lose 50%, you need to gain 50% to break even. Wrong. If you lose 50%, you need to gain 100% just to get back to where you started. Let me give you the full picture. If you lose 10%, you need to gain 11.1% to recover. If you lose 20%, you need to gain 25% to recover. If you lose 50%, you need to gain 100% to recover. If you lose 90%, you need to gain 900% to recover. Do you see the problem? Losses are mathematically devastating in a way that gains can never fully compensate for. The math is permanently working against you every time you lose capital. This is why Buffett is so obsessed with rule number 1. It's not emotional, it's pure mathematics. Every dollar you lose takes exponentially more effort, time, and compound interest to recover. And time is the most precious resource in investing. Time is what allows compound interest to work its magic. Every year you spend recovering from a catastrophic loss is a year you're not compounding your gains. Charlie Munger, Buffett's longtime business partner, put it perfectly. The first rule of compounding is to never interrupt it unnecessarily. Every major loss interrupts your compound interest journey, and interrupting compound interest is one of the most expensive financial mistakes a person can make. So how does Buffett actually apply this rule when he's looking at investments? Let me walk you through his process. Step 1. Understand the business. Buffett famously only invests in businesses he understands. He calls this his circle of competence. If he can't understand how a business makes money, he won't touch it. This isn't laziness, this is discipline. You can't calculate the intrinsic value of something you don't understand. And if you can't calculate intrinsic value, you can't apply a margin of safety. And without a margin of safety, you're just gambling. Step 2. Evaluate competitive advantages, the economic moat. Buffett looks for businesses with wide, durable competitive moats, advantages that protect the business from competition over long periods. A moat could be a powerful brand like Coca-Cola. It could be a cost advantage like GEICO Insurance. It could be network effects like Amerex Express. Why does the moat matter for rule number 1? Because a business with a strong moat is less likely to see its earnings permanently destroyed. It's more predictable, and predictability protects capital. Step 3. Evaluate management. Buffett wants honest, capable managers who treat shareholders like partners, not corporate insiders looking to enrich themselves at investors' expense. Bad management is one of the fastest ways to permanently destroy capital. Step 4. Determine intrinsic value. After understanding the business, its moat, and its management, Buffett estimates its intrinsic value, what the entire business would be worth to a rational private buyer. Step 5. Only buy at a discount, the margin of safety. And then, only finally, Buffett considers the price. If the market is offering the business at a significant discount to his estimated intrinsic value, he buys. If not, he waits, sometimes for years. And this is why Buffett says, be fearful when others are greedy, and greedy when others are fearful. Market crashes and panics are actually gifts for patient investors who have done their homework because they temporarily push great businesses below their intrinsic value and create margins of safety that would never exist in normal markets. Now, let us get practical. What are the most common ways everyday investors violate rule number 1 without even realizing it? Mistake number 1, buying what's hot right now. When everyone is talking about a stock, when your uncle brings it up at dinner, when it's trending on social media, that's usually a warning sign, not an invitation. Hype-driven investing ignores intrinsic value entirely. You're not buying a business, you're buying popularity, and popularity is the most expensive thing in markets. Mistake number 2, ignoring valuation. A great business at the wrong price is a bad investment. Paying 100 times earnings for even the best company in the world can still lead to devastating losses if growth slows or markets re-rate the stock. Price matters, always. Mistake number 3, using leverage you can't afford. Margin and leverage amplify both gains and losses. The problem is that leverage forces you to sell at the worst possible time, when markets are down and you face margin calls. Buffett has almost never used leverage. He has the patience to wait because he has never borrowed money to invest. Mistake number 4, panic selling during crashes. This is perhaps the most common way ordinary investors permanently lose money. They buy a stock during good times, the market crashes, they panic and sell at a loss, and then the market recovers, but they're no longer in it. A temporary unrealized loss becomes a permanent realized loss because of emotion. Mistake number 5, speculating without knowing it. Many people think they're investing when they are actually speculating. If you are buying something purely because you expect someone else to pay more for it in the future, with no reference to the underlying business value, that's speculation. Speculation is not inherently wrong, but you should know when you are doing it, and you should never bet money you can't afford to lose. So, here's what I want you to take away from this video. How do you, as an everyday investor, apply rule number 1 in your own life? First, build your own circle of competence. Make a list of industries and businesses you genuinely understand. These might be businesses in your field of work, businesses whose products you use every day, or businesses you have studied deeply. Only invest within that circle. Second, before you buy anything, ask yourself, how much can I lose? Not how much can I gain, how much can I lose? Look at the downside scenario, honestly. If the company went bankrupt, what would happen to your capital? Can you live with that outcome? Third, learn the basics of valuation. You don't need to be a CFA or have a finance degree. You just need to understand concepts like price-to-earnings ratios, free cash flow, and basic discounted cash flow thinking. The goal is to have some reference point for intrinsic value, so you're not buying blindly. Fourth, be patient and demand a discount. Never pay full price for anything. Wait for opportunities where the market is temporarily irrational, during crashes, corrections, or when a good business is temporarily out of favor. That's when your margin of safety appears. Fifth, think long-term. Rule number 1 only works if you give your investments time to realize their intrinsic value. The stock market is a short-term voting machine and a long-term weighing machine. In the short term, stocks go up and down for irrational reasons. Over the long term, price converges to value. Give your investments time. Here's the truth that most people in the financial media don't want you to hear. Getting rich through investing is not about finding the next 10-bagger, or timing the market perfectly, or getting hot stock tips. It's about not losing. It's about protecting your capital, buying great businesses at fair prices, and giving compound interest the time it needs to work its magic. Warren Buffett didn't become the greatest investor of all time by taking crazy risks. He became the greatest investor of all time by being extraordinarily disciplined about not losing money. And over 60-plus years, that discipline compounded into one of the greatest fortunes in human history. Rule number 1 is not just an investing rule, it's a life philosophy. It says, be humble, be patient, be disciplined, and protect what you have, because what you protect today becomes the foundation of what you build tomorrow. I'm Mano. If you found value in this video, please hit the like button. It helps this channel more than you know. Subscribe so you never miss a video on smart investing principles. And drop a comment below. What is your rule number 1 when it comes to investing? I read every single comment. I'll see you in the next one.